Hello guys, welcome to this a series of videos where I'll discuss all the concepts that that are important to become an independent trader, right? So you want to trade on your own and not depend on anyone, right? So this series covers a wide range of topics, and the first topic that we have for today is understanding about the market and the nature of the market, right? So and over the time, by the end of this series of videos, it could run into like 7 or 8 videos. So my objective is to cover all the concepts that are very much essential in your journey to become that independent trader who can understand what the market is doing and react to the market rather than predict the market and just trade based on what the market is telling you from the price and the volume, right? So in this process we will use market profile as a tool to analyze the price, right? For analyzing the price we will use the market profile technique. uh, that is very useful, and for analyzing the volume we will use the open interest data that is available on OA analytics tool, right? So if you can analyze the price and volume very well, then there's no other information that you'll be needing, in order to trade successfully, right? the, with that background we'll move on to discuss what exactly is market and uh, what it can do and what is its nature, to just be sure that okay, so we are dealing with something of this sort, then we'll be careful and what to do and what not to do, right? So with that said, we'll move forward. So the first question that I have is or anyone might have, so what is the objective of the market, right? So why there's a market, right? So obviously the market's main objective is, if you see, it's facilitating the trade. That's the only objective of the market, right? So the market objective is not moving anywhere, moving here, moving there, or staying. That's not the objective of the market. Market's objective i- in its essence is to just facilitate the trade to all of its participants, right? So for example, if you go to a vegetable market, there what it does is it enables all the sellers to sell their products, and buyers come there and buy that, right? So it's just a facilitating platform which facilitates trade. That's the main objective of the market, right? So then moving forward, like, so that is fine, okay, it is facilitating trade, but the thing that as a trader we would like to understand is how it actually moves, right? So how the market moves, right? So as similar to any other market, like even vegetable market, or if you take any other market, right? So it always, the market is dependent on two factors, which are demand and supply, right? So if you see, the market moves by demand and supply imbalances. So for a market to move, there should be a demand or supply that is not in balance, that should be there for the market to move to in a particular direction, right? So these demand and supply imbalances are the things that move the market, right? And these demand and supply are caused by money, right? The amount of money that is coming in will tell how much demand or how much supply is there in the market, right? So and sometimes there is no imbalance in those forces of demand and supply. So that's where you will see some equilibrium happening between demand and supply, and you will see the market getting stuck in a range and not moving much to the either side, right? So the demand and supply imbalances are the main factor which moves the market, right? So that is how the market moves. So demand and supply more than price. Price is a consequence of demand and supply, right? So price is a, like, after fact of like what happens through demand and supply. That is what is the result is the price. It's the consequence. The cause is the demand and supply, right? So we should understand the demand and supply more than the price, so that how much of the demand is there or how much of the supply is there, to understand what price can do as a consequence. So that is uh, that has to be our focus if we really want to understand where the price is gonna go, right? So that's why I say your focus should be on understanding what extent of money power is active at a particular price, right? So if you, for example, if you take a particular price of a underlying or stock, so you have to analyze how much of demand or how much of supply is coming at a particular price to really guess or to really anticipate like in what direction it can move from that particular price where this demand or supply came, right? So that should be your focus. Analyzing the demand and supply imbalances is your focus, right? So then you will know, or you'll be able to anticipate the move, the market move in a certain direction, right? So that is the second point that I wanted to convey, like the way that the market moves. It's all demand and supply. There's nothing else that can move the market. All the news, everything that you see has to translate into actual demand and supply, and that is what moves the market, right? Then we move on to different types of market players. So having said about demand and supply, so this is also very important in terms of understanding like the behavior of different kinds of players in the market, right? So for example, for if we take us as a retail trader, so we mostly react to the market because we can't really influence the market, right? So if I go and sell 2 lots or 3 lots of Nifty, or if I go and buy 2 lots or 3 lots of Nifty, I can't really move the market much, not even by a tick, right? So like most of the retail traders, even those who have quantities of like 10, 15 lots, they can't really move the market, right? So here I'm talking about the types of players based on their influencing power and their behavior, right? So here I have divided them into two parts. One is initiative buyers and sellers, and other part is responsive buyers and sellers. So initiative buyers and sellers are the guys who are very aggressive, right? So these guys are aggressive and they have like huge money power and they can create the market activity rather than reacting to market activity, right? So by aggressive, I mean, like, see, for example, you'd be thinking, like if you see a normal candlestick chart, right? So you think, okay, here there's a support price that is there. But these initiative buyers or sellers are the guys who have the power to initiate a move to break that support or break that resistance. So that is the aggressive nature of these guys who are initiative buyers and sellers, and they create a new market activity which is not existing at any point. They create a new market activity, right? So and in contrast, responsive guys are those who wait for a price and respond there. That is what they do, because they don't want to create any market activity, but they are just reacting to that market activity. Whatever the market is doing, they are reacting to it. Say, like as a retail trader, that's what we can do, right? So we are normally comes in the category of like responsive buyers or sellers, right? When we see higher prices, we try to sell it, right? But who is selling even the lower price? Those are the guys who are aggressive and they're initiative guys, right? So this is the distinction that we have, and when you see the actual demand and supply imbalances, right? So when you actually look into the open interest data and look at different buying and selling that comes in the market at different prices, so you should be able to differentiate between who is initiative and who is responsive, and who is trying to do what, right? So you have to be able to relate with these guys with the specific behavior, that whether these guys are aggressive or are these just reactive, right? So that is why this specific point is discussed here, and it is also very important because initiative players are the ones who create market activity, and the market moves because of these guys rather than responsive guys. Because responsive guys are waiting for the market to move, but initiative guys are creating the market move, right? So with this, this is one more important key aspect of the market, right? So then going to the part where like we as a trader, having known what the market is, right, and how the market moves, right, through demand and supply, and what are the different players are there in the market. So we have to have some like guidelines to follow so that we survive in the market, right? So first thing that we have to we have to be uh, we have to be mindful about is we have to be open minded, right? So we have, and at any given point we have to be open minded and think about all the possibilities that can happen, right? So say you have a bullish view in the morning, so you have to be very much flexible enough that you can change a view if the market price and volumes are suggesting a different activity that is happening. So you have to be open minded to think about the opposite of what you are thinking at a particular single point, right? So that is what I mean by open minded, right? So once you form a view, you also keep a track on the data and the price action, so to see if the market is actually trying to play it out or not, right? So whenever you form a view, like give that benefit of doubt to yourself by thinking through in the like stepping in the shoes of the market and thinking if this is what the market is trying to do, right? So that eliminates your what do you say, your preconceived notion about the market, or so it validates what you're thinking basically. So that is what is like, we have to be open minded in that sense. So once we form a view, we should not like blindly take that this is the view that I have. So you should have a conviction, I agree, but you should also think about possibilities, like what is the probability of a thing happening in opposite direction than what you're thinking right now, right? So that is what I mean by open-minded. So if we don't do that, what happens is that we will stick on with one view and expect the market to oblige. But what the market does is not dependent on any single guy's position, unless he has a huge money. Like I'm talking about a normal as a retail trader, right? So we are only reactive to market and we can't influence it. So our only job is to follow the market, right? So rather than waiting the market to oblige to our view, right? So if it's not following, we get out quickly with uh, as much less possible loss as possible, and we try to again get into the direction of the market what it does, right? So that is what I mean by being open minded, right? Then we move on to the key points that we should have as a retail trader. We should not do some things so that we are still in the game, right? So after these, we'll have some do points as well, but first I wanted to cover what you shouldn't do, right? So that you are still in the game and you'll be able to play this game and yeah, and maybe turn profitable after that, right? So first thing that is, so any trade that you enter, you should have an exit plan right before you enter a trade, not after you enter a trade, but you should have a exit plan right before you enter a trade, and you should have a stop loss at least in your mind. And if you're before screen, at least you should have this in your mind, so that you know where you're going wrong, and you're accepting your defeat. That is what. So having an exit plan is very very important to survive as a trader, right? And the second thing that is very important is you shouldn't risk a heavy part of your capital in just one single trade. How much ever the conviction that you have on a particular trade, you should not risk like say 70% of your capital in one trade. Then you'll not be able to, if you go wrong, then you'll not be available in the market to trade, right? So that is also one important thing you should be focusing on. And a position size is something you should size according to the risk per trade that you want to take, right? So maybe you fix a 1% of your capital as a risk per trade, and decide your position size based on that, right? But don't risk like heavy part of your capital in one trade, right? Then the third point is that, so you're holding on to your losing position when the market is having a price and volumes in support of an opposite direction to your position. So the market is creating activity to cause a move in opposite direction of what your current position is, but you're still willing to hold your position even after your position has negated your exit plan as well, right? So that is what you shouldn't be doing uh, to survive as a trader, right? So then the last and very important thing, and this is a problem for many of the traders. So we have that compulsion to trade, right? So the moment the market opens, we want to place a trade, and that temptation is always there, right? So the temptation is always there, but you should be you should be waiting. Like, so if the market is not giving the right opportunity, so you should be willing to wait for the market to give you that opportunity rather than jumping in early and getting stuck in the market, right? So that is very very important as a trader to survive, because it all depends on where you enter and how what the market does after that. Because so if you're jumping in early without enough evidence that your view is correct, then what happens after that is you turn reactive, right? So you turn reactive not to the market, but you turn reactive to your position, right? So if your position is running into loss, then you'll be like you'll be waiting for the market to come to a point where you'll exit in minimal loss or something like that. So that will cause that will cause an unnecessary loss to your account, right? So the timing is very important, and you have to wait for the right opportunity to come in, right? Then the last part of it, so what should we do as like the points which we should follow being a retail trader, right? So the first and foremost point, the only thing which is in our control as a retail trader is the risk that we can take on a particular trade, right? And for that we should have an exit plan before we enter a trade, right? Or once you enter a trade, you should have an exit plan ready, so that whatever you lose on the trade, you already know it before, right? That is one thing you should really focus upon, right? And within this point we also want to mention that, so position sizing also you have to take care, and whatever the risk that you're taking per trade is in control, and this doesn't decide your entire trading, like trading career, right? So this one trade is not going to impact your capital as such in a very big way. That's what you have to focus, or you have to be taking care of, right? So the second thing is, you have to follow the market, and believe in what the market is doing in terms of its price and volumes, right? So you have to follow that trend, and never try to fight what the market is actually doing, right? For this you have to know like what the market is doing. That we'll cover in the next series of videos. But remember this point: when the market is doing something, don't expect out of nowhere something sudden will happen that will cause the market to reverse the other way, right? So as long as you are not in a position, don't expect that to happen, right? So yeah, once you're in position, you have to keep risk in check, and you should have an exit plan, and be flexible enough to exit your position. But believing in the trend and price and volumes is most important factor, and you should never try to fight it, right? So next thing is, so we also have to be cognizant of the fact that the market is supreme, right? Because it is not moving accordance with the intentions of a single player, but there are buyers and sellers who are trying to negotiate and causing demand and supply, and the market moves uh, through those demand and supply imbalances, right? So anything can happen anytime, where an aggressive player can come in at one point, and stuff like that can happen, right? So that's why we have to believe the activity of the market, and we have to also consider the price, what the price is doing, and if possible try to not focus on any other thing except the price and volume, right? So except the price and volume, everything is discounted in these two things, guys. Because only if the price moves, then only a particular guy is making profit or loss. Or even if the volume, the demand and supply changes, then only the market will move, right? Any news or anything, it has to finally come into price and volume. It has to translate into price and volume to for the market to move, right? So that's why you just believe that market is supreme and follow just the price and volume, not anything else, right? So the volume is indirectly means the money that is coming into the market, right? So this is the basic introduction for the market, and to understand like what the market can do, and what we should do as a retail trader. So this is my view on this, on the way that one should approach the market, right? So in the next series of videos, we'll cover a different range of topics on market profile and the open interest. The market profile is mainly focusing on the price aspect of the market, and the open interest will be focusing on the volume aspect of the market, right? So once we cover all the concepts related to price and volume, so we'll know what is happening to price and volume, and with that information, we can anticipate what could happen to the price later, right? So once we have that information, we can anticipate the price movement in the market, right? So that's it. I'll wrap up this particular video, which is just heads up on market at the Mr. Market, and we'll see you in the next video, right?